Hello, everyone. Welcome back to our new episode of Phillip Trading Podcast. My name is Liao, and today we have Trent with us. He's a senior dealer and marketing executive from Phillip Futures. How are you doing, Trent?
Yeah, I'm feeling good today. Good to be back here.
Okay, thanks, Trent. Good to hear that. Now, if you are closely watching the market recently, I believe that our audience would come across the headlines about the inverted US Treasury yield curve. It has been seen that the widely tracked US 2-year and 10-year Treasury yield curve briefly inverted on last Tuesday for the first time since September 2019, as bond investors bet that the aggressive tightening by the Federal Reserve could hurt the US economy over the longer term. Now, we know that when the longer dated yields fall below the shorter ones, it shows that there's a lack of optimism in the future growth. In addition, when the 10-year yields fall below the 2-year rates, it will be seen as the beginning of a recession. Now, so without further ado, let's have Trent to talk us through our topic for today. Should you worry about the inverted US Treasury yield curve? So first question for you, Trent. Can you explain more details on what does inverted yield curve mean and the implication it means to the market?
Okay. So the US Treasury finances federal government budget obligations by issuing various forms of debt. So there are actually 23 trillion Treasury market, which include Treasury bills with maturities from 1 month out to 1 year, and notes from 2 years to 10 years, as well as 20 and 30-year bonds. So the yield curve actually plots the yield of all these Treasury securities. Okay. Typically, the curve slopes upwards because investors expect more compensation for taking on the risk that rising inflation will lower expected return from owning longer dated bonds. That means a 10-year note will typically yield more than the 2-year note because it has a longer duration. So yields move inversely to prices. Investors watch parts of the yield curve as a recession indicators, primarily the spread between the yield on a 3-month Treasury bill and the 10-year notes, and also the US 2-year to 10-year, we call it a 2/10 curve. So on Tuesday, the 2/10 part of the curve inverted, meaning yields of the 2-year Treasury were actually higher than the 10-year Treasury. There is a warning light to investors that a recession could follow. The US curve in the past, the US curve has inverted before each recession since 1955, with a recession following between 6 and 24 months. According to a 2018 report by researchers at the Federal Reserve Bank of San Francisco, it offers only a false signal just once in that time. Okay, the last time the 2/10 part of the yield curve inverted was in 2019. Okay, the following year, the United States entered a recession, despite that being caused by the global pandemic.
Okay. Yeah, thanks. So yes, indeed. So next time, our traders would need to take note on the bond market, particularly when the short-term yield is higher than the long-term yield. Now, so next questions. Are we likely to see a recession ahead in this year, 2022, and onwards with the inverted curve yield?
Okay, so the use of the short-term US government bond have been rising quickly this year, reflecting expectations of a series of rate hikes by the US Federal Reserve. Okay, while longer dated government bond yields have moved at a slower pace, amid concerns policy tightening may hurt the economy. Okay, still another closely monitored part of the curve has been giving off a different signal. Spread between the yield on a 3-month Treasury bill and a 10-year note this month has been widening, causing some to doubt a recession is imminent. And meanwhile, the 2-year and 10-year curve has technical issues, and not everyone is convinced that the flattening curve is telling a true story, because this is mainly due to the Fed's bond buying program of the last 2 years has resulted in an undervalued US 10-year yield that will rise when the central bank starts shrinking its balance sheet, steepening the curve. Okay, so the researchers at the Fed meanwhile put on a paper on March 25 that suggested the predictive power of the spreads between the 2-year and 10-year treasuries to signal a coming recession is probably spurious, okay, and suggested a better herald of a coming economic slowdown in the spread of treasuries with maturity of less than 2 years. So overall, we cannot actually confirm a recession in the coming months or years, but it is certainly an indicator that we should be aware.
Okay, yeah, so let's see what the market would react when that happens in months to come. Okay, so Trent, what are the things that traders or investors that they need to look out for and do when the inverted US yield curve posts a warning signal?
Okay, while it's a good indicator of future economic woes, and even the yield curve has not been a very good timing for equity investors. So for example, investors who sold when the yield curve first inverted on December 14, 1988 missed a subsequent 34% gain in the S&P 500 index. Those who sold when it happened again on March 26, 1998 missed out another 39% additional upside to the market. So in fact, the median return of the S&P 500 index from the date in each cycle when the yield curve inverts to the market peak is actually 19% return. So hence, it might be still early to short the US stocks at this point of time. Okay. Also worth noting that the 3-month and 10-year spread is far from inverted, and investors should also watch this indicator as well. The 3-month and 10-year spread is seen as even more reliable and has been more popular among academics and noted researchers at the San Francisco Federal Reserve.
Okay, yes, indeed. So these are the things that the traders should watch out for and monitor, accordingly. Okay, so last question for you, Trent. So how can traders capitalize and take a view on US Treasury yield?
Okay, so for investors who wish to trade the US Treasury yield, they can actually trade the new CME Micro Treasury yield futures, which are available as a 2-year, 5-year, and 10-year, 2-year, 5-year, 10-year, and 30-year Treasury yield. The Micro Treasury yield futures is different as compared to the existing Treasury note futures, as investors trade on the yields itself rather than the bond prices of the existing futures products. In addition, the Micro Treasury yield has smaller margin requirement as compared to the existing Treasury notes futures. So this will allow investors with smaller capital to participate in the Treasury yield market.
Okay, all right, thank you, Trent. Thank you for sharing on the US Treasury yield curve and let us know the importance to monitor the US yield curve from time to time, in which probably the general retail traders are not paying sufficient attention to judge the market health. Okay, so for those who wish to trade US Treasury yield and want to know more, you can visit our website or you can also drop us a message or comments on our social media platform, and we will be in touch with you for more details. So now we have come to an end on our podcast for today. And once again, thank you, Trent, for the wonderful sharing today. Happy trading, everyone. See you guys next round. Goodbye.
Okay, thank you. Bye.